What is going on, everyone? This is Jacob Amaral here. In today's video, we're going to be talking about the double bottom pattern, specifically the double bottom candlestick pattern, and can it be used to find an edge in automated trading systems in the market? If this is your first time watching this video, hi, my name is Jacob Amaral. I build and code automated trading systems in the futures market and build portfolios to hopefully give me a return in the market. I also teach you how to code and build great trading systems, and you can find that in the description or in the comment section below. So anyways, today's video, we're gonna be talking about the double bottom pattern. Will the double bottom pattern outperform buying and holding investments? Stay tuned to find out. I will be testing the double bottom pattern on daily and minute bars with 3 different exit types. And we're going to compare that to buying and holding an index and see if it outperforms it. It could outperform by straight returns, absolute returns, or have a lower risk adjusted return. So we're going to be testing that out and seeing if there's any edge in the market with this double bottom pattern. So the double bottom pattern will be our entry, and then we're going to have multiple exits. We're going to start with a 2% profit target and a 1% stop loss. We're going to do a 3% trail stop and exiting on the next bar. And we're going to see how that compares to buying and holding an index. A double bottom pattern is a classic technical analysis charting formation that represents a major change in trend and a momentum reversal from a prior down move in market trading. It describes the drop of a security or index or derivative, a rebound, another drop to the same or similar level as the original drop, and finally another rebound, which ideally, should happen. The double bottom looks like the letter W. The twice touch low is now considered a significant support level. While those 2 lows hold, the upside has new potential. In technical analysis of financial markets, a double bottom is significant in that it suggests an important low or a strong level of support has been reached following a down move. While the double bottom low remains in place, price movement is likely to exhibit a retracement higher and possibly indicate the beginning of a new uptrend. By the same token, a drop below the double bottom lows in subsequent periods suggests that the downtrend is resuming and bears have reasserted their dominance. As many chart patterns, a double bottom pattern is best suited for analyzing the intermediate to long-term view of the market. Generally speaking, though, the longer duration between the 2 lows in the pattern, the greater the probability that the chart pattern will be accurate. For example, a double bottom on a minute bar might not be as accurate, but on a daily or weekly bar, it may be very accurate. So that sounds great and all. It's cool, technical analysis, patterns, but does it actually outperform the market? Many hedge funds and automated trading systems might use patterns in different trading systems, right? And I'm sure that the double bottom pattern is one of them, right? The question is, how often does it happen? Is there actually an edge in the entry? And what's more important is the actual exit stage, right? Entries can be okay, but usually you need to handle the exits the best, right? And when it comes to, outperforming a buy and hold investment, our double bottom pattern might be a better way to, buy and hold an asset when you wait for double bottom patterns and then you just add to that position and add to that position. But in terms of an actual trading system where maybe it's more to medium to short term trading systems, we'll have to see if a double bottom pattern has any edge and can perform better than, say, a buying and holding an index. So once again, I'm going to be testing the double bottom pattern in multiple different scenarios, right? We're going to be testing it with 3 different exits, a 2% profit target, 1% stop loss, a trail stop, and exiting on the next bar, okay? So I'm going to run those results and then show you on the screen how each one did, and then we're going to compare it to buying and holding an index. So let's get started with this test, and we'll see you soon. All right, so I just finished up my results here with each of the tests, so let's take a look. So I did from 2021 until 2022 today, November 7th. Okay, SPY, which is the S&P 500 index, over that period of time returned 1.62%. And then, okay, so I did daily bars and then minute bars. So daily, exiting after 1 bar was red, returned negative 2%. Now there is a note, there's only one trade. There's only one double bottom pattern on daily bars, at least with my software, in terms of detecting a double bottom. So it is a little bit skewed. If there's more trades, that would have been better. Maybe I should have did like 60-minute bars or, half day bars, but there's only one trade. So they all lost money. Exiting after 1 bar, lost 2%. 2% profit target, 1% stop loss, obviously lost 1%. And then 3% trail stop, lost 2.2%. You can see the minute was a lot different. So exiting after 1 bars was a lot worse, which kind of makes sense. There's a lot more trades on minute bars. So if a system does poorly, it's going to lose a lot. 2% profit target, 1% stop loss, negative 5%. But look at this, a 3% trail stop with the double bottom pattern netted a positive 10.26% return, which is fantastic. That outperforms the SPY by 8% at least. So it does very well. Now there is a note. I'll actually put this in here. It is swing trading, so it's not exiting at session close, meaning it's not exiting when the market closes. So that may play a factor. If you only want intraday trading systems, this may not do very well. So that's how it did. Now you're probably asking, like, how did I detect these double bottom patterns? How did I back test them? So that's a really good question. I developed my own software. It's called StratGen. And what it does is it allows me to back test trading systems without writing code. And one of the options, one of the features is a pattern detection tool that I built myself. And I can use these patterns to make trades. So what you're seeing on the screen here is StratGen, which is a piece of software built into NinjaTrader, which of course I built, or not NinjaTrader, I built StratGen. NinjaTrader is what I use to execute my trades on and kind of the overall platform, but StratGen is kind of like an app on top of that. So here on the right side, we have strategy StratGen. And you can see I have a long signal here, right? Long on 1 minute bars. And the indicator that uses is pattern. And the signal pattern is double bottom. Okay, so when I select that, what it'll actually do is auto detect these double bottom patterns and then place a trade. Okay. And then I can define my exit. So what you're seeing here is it's exiting after 1 bar. But if I wanted to do that 3% trail stop, all I would do is uncheck the exit. Go down to the exits here, percent, trail stop, 3%, and then hit run. And then for every exit, it will attach a 3% trail stop order in the back test and give me a result. So there's that result. Now, as I was saying, this is swing trading. So if I check this exit on session close right here, you probably can't see it because my face. Here, let me move my face over. Exit on session close. That's going to sell at 4 p.m. So let's see if enabling that, if we still get as good as a return. I think it's not going to be good. The trail stop only works good usually when you're holding for a longer period of time. So I'm going to check it. Oh, wow. Okay, it still does 8.1% return, which is really good. So that's not too bad. So I'm very surprising. But anyways, if you're looking to, do double bottom patterns very easily, definitely check out StratGen, which is a product I built. Our website, stratgen.io. Just put it in here if you're interested. I'll put it in the description below. But it allows you to easily back test and run new strategies without writing code. And I built it myself, so it's a lot faster for me to do that. But anyways, that's the results. Very interesting. So overall, the 3% trail stop on minute bars did the best. I mean, it was the only one that made money. The rest lost money. But let me know in the comments below if you want me to try other patterns or other strategies and compare it to buying and holding. If you find value in this, I know I do. I like testing strategies and seeing what outperforms the market so I can add it to my portfolio. But anyways, that's the video, guys. I hope you enjoyed and found value, and we'll see you next week. Bye, guys.